Hello class, this is Chapter 3, the financial environment, markets, institutions, and investment banking. So the learning outcomes describe the role that financial markets play in improving the standard of living in an economy. Objective 2, describe how various financial markets are differentiated. 3, discuss the role that an investment banking house plays in the financial markets. 4, describe the role that financial intermediaries play in the financial markets and explain why there are so many different types of intermediaries. Objective 5, describe how financial markets and financial intermediaries in the United States differ from those in other parts of the world. The financial markets. Financial markets represent a system that includes individuals and institutions, instruments, and procedures that bring together borrowers and savers, no matter the location. The primary role of financial markets is to facilitate the flow of funds from individuals and businesses that have surplus funds to individuals, businesses, and governments that need funds in excess of their incomes. Funds or flow of funds, 3 financial phases. Young adults borrow, older working adults save, retired adults use savings. The funds transferred from savers to borrowers, there's a direct transfer, investment banking house, and then there's financial intermediary. So here's an example flow chart of what this might look like. Direct transfer. So the business to saver, the saver gives money to the fund, gives funds to the borrower. Indirect transfers through an investment banking. So the saver has funds, and that goes into the investment banker. This is like if you did a CD or stock or things like that. Funds less issuing to the borrower, then the bonds go, and it's kind of a cycle that goes continuously happens. Indirect transfer through a financial intermediary. So here's the saver, here's the borrower. This kind of tracks how this happens. The saver or the investor puts money into the financial intermediary, and then the borrower uses it. Sometimes the actual saver also will get money out as well. Sometimes the saver becomes a borrower. So that's kind of a little bit more detailed analysis. Market efficiency, economic efficiency funds are allocated to their optimal use at the lowest cost. So the key is to be the most efficient, operate the most efficiently. And when the economy operates as efficiently as possible, that's when the cost of things come down. That's how we improve things. For example, whenever you do cost savings within a business, you try to make things run as lean as possible. Market efficiency. So there's informational efficiency. Investment prices are adjusted quickly to reflect current information. Weak form. All information contained in past price movements is reflected in current market prices. Semi-strong form. Current prices reflect all publicly available information. Strong form. Current prices reflect all pertinent information, both public and private. So the types of financial markets, there's money market versus capital markets, debt markets versus equity markets, there's primary markets versus secondary markets, and there's the derivatives markets as well. So those are different ways of investing. So general stock market activities, the secondary market, trading in the outstanding previously issued shares of investment instruments. The primary market, additional shares sold by established publicly owned companies. An IPO, which is an initial public offering market, offerings by privately held firms that are going public with their shares. I don't know if you remember maybe about 5 or 6 years ago, Facebook went public. That means that anybody in the United States could buy shares on the New York Stock Exchange or any of the stock markets. That's what an initial public offering is. That happens when a company that is private becomes public. So what that means, there's some different ways to look at it. That means anybody that invests in the stock market and they own shares, then they're their shareholders. So keep that in mind. Stock markets, physically, stock exchanges, New York Stock Exchange. Then there's American Exchange as well, and then there's also regional exchanges. There's also the Chicago Exchange. Exchange members, there's floor brokers, designated market makers, there's specialists, there's supplemental liquidity providers, SLPs. So typically, if you are going to be work on the stock market, you usually have to study to get a series, I think 6, 7, and 8 license to be a broker or a trader. So those are some additional careers you can have if you want to pursue finance and, you know, be a financial planner, things like that. But you definitely have to get and pass a series 6, 7, or 8 test. So to have a stock listed, apply to the exchange, pay a relatively small fee, and meet the exchange minimum requirements. So these are all conditions that you have to meet. So here's an example of the NASDAQ. So here's some comparisons. Right here it says round lot shareholders 400, regional 800, NASDAQ 300. So in millions, so 1.1 million shares out there, 500,000 shares, 1.1 million. Assets in millions, so 75, 4, and 50 million. Pre-tax income, so this will be $2 million, 750,000, and then 1 million as well. So if you went and look at the New York Stock Exchange, or sometimes whenever you're watching MSNBC or let's see what other channels, Fox Money, at the bottom you see the little stuff going across the screen, and these are the numbers that they usually talk about, and the value of the shares in the exchange for the day. Stock markets, over-the-counter markets, and the NASDAQ network of brokers and dealers. There's auction market, organized investment network. There's also electronic communication networks, ECNs. Regulation of securities markets. The Securities and Exchange Commission has jurisdiction over most interstate offerings of new securities to the general public. Regulation of national securities exchanges. Power to prohibit manipulation of securities prices. Control over stock trades by corporate insiders. So for example, I don't know if you all remember about 8 or 9 years ago, maybe 10 years ago, oh gosh, I can't remember the blonde lady's name. Martha Stewart, that's her name. Martha Stewart was doing some insider trading. She knew information that she got from her friend or something like that. Anyway, she made some trades. She sold some stock because she knew it was going to fall. Well, she got in trouble and she ended up serving jail time. It's really interesting though that Martha Stewart is the one that was had to serve jail time, even though people with Enron, which happened I think in 2007. No, actually that was probably Enron happened in the early 2000s, where this energy company in Texas did inside trading, and they ended up filing for bankrupt, but none of the top executives who were male, none of them went to jail, even though they had purchased billions and millions of dollars of land and real estate in Colorado ranches. I think one person had bought a ranch for like $800 million, but the guy never went to jail. So pretty interesting that happened. So the investment banking process, investment banker helps corporations design securities attractive to investors, buy the securities from the corporation. Resells the securities to investors. So if you are a public traded company, you do have an investment banker. Usually, sometimes they're backed by companies like Morgan Stanley, Dean Witter, ING, some of these really big banks. Well, Wells Fargo, Bank of America. So these are all investment bankers. So the process: raising capital, which is stage 1 decisions, dollars to be raised. They question how much money do we need to raise. They identify the type of security used to raise the funds, and then they select an investment banker to utilize. Competitive bid versus negotiated deal. Sometimes they bid out the process as well, or they negotiate a deal with a business or investment bank. So continued investment banking process. Raising capital is stage two decisions. So you reevaluate the initial decisions, best efforts or underwritten issues, underwritten arrangement. Investment bank guarantees the sale. by purchasing the securities from the issuer. Okay. Best effort arrangement. Investment bank gives no guarantee that the securities will be sold. Issuance or flotation costs. Okay. And these are some of the things we'll take a look at in more detail. Setting the offering price. So the investment banking process, so the amount of issue, NP is net proceeds divided by 1 minus the F value or the flotation cost as a decimal. So here's an example. A firm needs 470,000. The flotation costs are 6% of total issues, so we're going to go 1 minus 0.06. So then I think that's like 0.94. Okay, so 470 divided by 0.94, which is $500,000. So if 500,000 is issued, 30 equals 500 times 0.06 in flotation costs will be paid, which leaves 470 for the firm. So all we're trying to do is trying to find the total value of it, considering the flotation costs are 6%. So selling procedures. The underwriter is a syndicate. It's a group of investment firms formed to spread the risk associated with the distribution of new securities issues. So keep in mind, the newer the company, the higher the risk. The more solid, the better reputation a company might have, the lower the risk. But keep in mind, a lot of times whenever your risk is higher, your gains can be greater as well. And likewise, if you have minimal risk, your gains are lower. So you have to manage that and take that into account. Lead or managing underwriter, the member of an underwriting syndicate who manages the distribution and sale of a new security offering. Okay. Selling group, a network of brokerage firms formed for the purpose of distributing a new issuance of securities. Okay, let's see. And then it's not last, but self registrations. Securities registered with the SEC for sale at a later date. It's called held on the shelf until the sale happens. Otherwise, they say we'll just keep it on the shelf until, I don't know, June 1st or whatever date they decide. So the investment banking process continued maintenance of a secondary market. When a company is going public for the first time, the investment banker is obligated to maintain a market for the shares after the issue has been completed. Okay, so the lead underwriter agrees to make a market in the stock and keep it reasonably liquid. Reasonably liquid means, remember, we can convert it back to cash, is what it's saying. Types of financial intermediaries: commercial banks, credit unions, savings and loans associations or thrifts, mutual funds, whole insurance companies, and also pension funds. Remember earlier I mentioned Enron. You can Google Enron and find more details. There's actually videos on Netflix about the whole Enron scandal. But down here at the bottom, what they did was they used a pension fund to pay for their expenses, in a sense. They were hiding their losses, and anyway, they were using pension funds to pay for a lot of the new research and development and the company to move forward. So they use a pension fund for that. But you can go ahead and take a look at each of these different financial intermediaries in more detail. So the role of the financial intermediary: facilitate the transfer of funds from those who have funds or the savers to those who need funds, meaning the borrowers. Manufacture a variety of financial products that take the form of either loans or savings instruments. For example, if you put money in a savings account, let's say you have Wells Fargo and you have $5,000. Well, the intermediary is Wells Fargo. So your $5,000, you have $5,000 on paper, right, electronically. So what they do is you take that $5,000, and what Wells Fargo does is they use that $5,000 and loan it out. Okay, that's a savings account. Now, with that one, a regular savings account like Wells Fargo, they have to keep that liquid because they keep your money liquid as possible. Your interest rate on it is like probably less than 1% per year. But if you put it in a CD, a cash deposit, you can get up to 6%, right? So if you, and there's usually a minimum on that, but I'm just giving you an example of the intermediary, and that's what this is talking about. They manufacture a variety of financial products that take the form of either loans or saving instruments. So we'll look at this a little bit more. So here are the benefits of financial intermediaries. They reduce costs, risk diversification, funds divisibility, meaning pooling, and they provide financial flexibility, and they offer related services. So if you have a retirement, whoever your pension is with, the state or the government, they actually invest in a balanced portfolio. What that means is they take your money and they put a percentage of it into high risk, medium risk, and low risk. Typically, whenever you're young, you want your investments to be higher risk, and then I'd say probably like 60% higher risk, 20% medium risk, and 10% low risk. Okay, so that's an example. But if you're a medium, let's say you're in your late 30s, 40s, then you'll probably want a medium risk. So then you'll probably want like 30% in high risk, 30% in medium risk, and your last 30% in low risk. Notice how it's staggered. So then whenever you're about age of retirement, then you're in I think a third of your investment will be in medium risk and 60% will be in low risk. So it's definitely staggered to protect your money. Okay. International financial markets, U.S. stock markets represents 35 to 40% of the total value worldwide. U.S. markets dominate the stock markets in other countries. A lot of companies, it's interesting that they say a lot of Chinese businesses and Chinese people own a lot of businesses in the United States. It's pretty true because they have the ability of investing in the stock markets in the United States. So that's why whenever we look at markets in global, the New York Stock Exchange is one exchange, and the NASDAQ as well are markets that are open for anybody to trade around the world. So that's just something that has been available for some time now, but it allows people in other countries to invest in our markets. I hate to say our, because like it says, we only own, or the United States only owns 35 to 40% of the markets worldwide. So financial organizations in other parts of the world, U.S. financial institutions are more heavily regulated. The Securities and Exchange, historically, U.S. financial institutions have faced greater limitations on branching services offered in relationships with non-financial businesses. So yeah, this is definitely, you have to look at the economic impact whenever you take a look at finances as well. I think that's one of the reasons why you might have taken a macro and micro economics class prior to taking your higher level business classes and finance classes, because you have to understand how the world economy impacts us here in the United States. In fact, I don't know if some of you are watching with the Navajo Nation, but Lizer is meeting with Trump's administration to open up the Chinese market, and they're using the sovereign immunity, which I'm not too sure if you've studied that. They're trying to use sovereign immunity, saying that we're a sovereign nation and we want to trade with China. So then we're looking, the Navajo Nation is looking at not having to pay for import and export and embargo taxes, things of that nature. So those are things that they're looking at. Okay, so just cold view. So that's why they say a macro view, and then we're the micro view. Okay. Legislation of financial markets. When financial markets perform poorly, Congress tends to regulate financial activities more than normal. When financial markets are performing efficiently and producing above normal returns, Congress tends to deregulate financial activities. A perfect example of this is whenever the housing market, the bubble busted back in 2008, 2009. I don't know if y'all remember when the United States, or the people of the United States, bailed out Wall Street. Well, the the companies, ING, Morgan Stanley, some of these big investment banking houses hedged the housing bubble. So I'm not too sure if you understand what hedging means, but what hedging means is they essentially bet that the housing market would crash. So the housing market crashed, so they ended up getting money. Well, ING and some other insurance companies that hedge these bets and provide insurance for these bets, well, they had to pay the money back, and that was kind of whenever the market crashed, they couldn't pay back these companies that hedged these bets. So and by the way, hedging is something that happens every day. In fact, NAPI hedges their corn as well up on the big farm south of Farmington, the Navajo Nation farm. We hedge corn up there. All we're doing is we're holding it for a future at a specific price. So if the price is above that hedge, NAPI makes more money. But keep in mind, we can also go the other direction as well. If the value of corn is lower than if we sell it, and they call it a margin call. So if a margin call happens, then we lose money. But the key to that is having the flexibility and the resources, the assets to hold that commodity. But we can get more depth to these discussions as we move forward. So that is the end of this lecture. If you have any questions, please feel free to email me. If you have questions, don't hesitate to ask. Make sure we get our discussion questions done. They'll be due the Monday morning, 8 o'clock. The new one opens up Monday as well. Assignments and exams are due midnight, Sunday night each week. So they'll be due Sunday night each week, and the new exams and assignments in Cengage are open at 12 a.m. or basically 12:01 in the morning or at midnight, and are open for you to work on. So I hope you all enjoy this class. Sometimes I get a little bit sidetracked when I'm talking about these concepts because it's pretty exciting for me to talk about. Just have all this information in my head. So anyway, hope you all have a good day. We'll talk with you all later.